Looking back over my youth, I am truly stunned how the brains of little boys work. It's almost a miracle that any of us survived. We played stupid games like Don't Flinch, was simply a test of the other person's ability to remain still and not react while potentially being attacked. If the person reacted and or flinched, the fake attacker got to hit the flincher in the arm. And if the person under attack didn't react, they got to hit the attacker in the arm. Now, if that game wasn't dumb enough, occasionally the attacker during their fake attack would accidentally hit the other person. In those cases, oh boy, that's when the game got interesting. Because as a punishment for making contact, the fake attacker would be punished by taking a hand flick to the, let's use the word junk. Well, it's safe to say what happened last week was like a version of Don't Flinch, because what this all boils down to is a simple psychological challenge or test from the market. It's all about testing your ability to control your reflexes, emotions, and remain calm under a perceived attack. Notice I use the words perceived attack. And that's important because what really happened? Take a moment to ask yourself, did last week fundamentally change anything about the current bull market? Have any of the fundamental drivers of the market changed? Or did price simply move in a direction you rather not see it go? The fact remains that technically nothing has changed about the macro environment. In terms of price charts, nothing has changed as well. We are still above supports and within normal Fibonacci retracement levels. Nothing structurally has broken or broken down. Again, ask yourself, did we suddenly start balancing our national budgets? Did the government say it's going to stop printing money all of a sudden? Did inflation disappear overnight? What we went through was one of the oldest tricks in the book, and it works every time because far too many investors look to price as validation and indication of what's happening in the market. Layer this with a variety of irrelevant pieces of information, and you can see why so many investors started flinching this week. Let me go through a few of these main talking points and explain why they are fake attacks on the gold and silver markets and why you shouldn't flinch. First, we had China announce that they paused or stopped buying gold. The minute I saw this report, I thought, why would China, a country known for their lack of transparency, all of a sudden decide to be forthcoming with information about their buying? Let's not forget all the times China bought and didn't disclose for months. Also, let's be clear, not buying is not the same thing as selling. Next, we had US job data come out and it was better than expected. Really, folks? The same jobs and employment data that is routinely revised downward a month or two later? Yes, wages did come in higher, and there was only a slight increase in unemployment numbers. But part of being a successful investor is learning how to interpret the data and not simply react to the data like most investors. Ask yourself, do these numbers tell you that all of our problems have been fixed? Or do they tell you that we simply are getting to our destination a little slower and not as quickly as we anticipated? It's like driving to Vegas and doing 100 miles per hour, and suddenly you start doing 80 miles per hour. Does it mean you still aren't driving towards Vegas? Or does it mean you're not going to go to Vegas anymore? No, it just simply means you aren't going to get there as fast as you were. That's what that data meant to me, at least. Now, let's talk about the price sell-off and or potential price corrections. This market is simply doing what every market does, even during a bull market. Prices don't just go vertical, and when they do, they almost always come right back down because of traders and profit takers. Gold and silver recent price appreciation pulled in a number of people who aren't real believers in metals like us. They are people who simply wanted to take a quick ride on the price train and are ready to jump off the minute it slows down. They aren't committed to the investment. They are committed to the trade. So they start taking profits and put downward pressure on the market, and then it goes from there. Please don't forget that market sell-offs, pullbacks, price corrections, or whatever you want to call it, are completely normal and healthy. It's not abnormal to see 20, 30, even 50% price retracements during a bull market. That doesn't mean the market's over. It's simply the market throwing fake punches to see who will flinch and get out of the game. The market needs the panic money to leave so they can buy your positions for cheaper. This is especially true for the traders. Finally, let's talk seasonality. Last year I did a video in May related to the phrase sell in May and go away. I will link to that video at the end for you to watch. In a nutshell, I break down this chart of seasonality and how historically some of the worst performing months for metals are June through August. While this trend could be bucked at any time, we also know that the trend is our friend until the end. If you understand this chart and understand human behavior, it's no surprise that we've started to see some price weakness. Not to mention, gold and many other metals were already coming in to the summer months overbought, so a price pullback should have been expected. Personally, I put my buying on hold and opted to store more cash over the last 2 months or so in anticipation of better buying opportunities over the summer, because it happens every summer. I will warn you that if you decide to take this approach, you also have to monitor price charts because, as we've seen, this market is supercharged. It can take off in a moment's notice, so you have to be on alert. As the saying goes, where the rubber meets the road is that we are only 8 or 9 weeks from gold's big breakout, and seasonality tells us that we should prepare for weaker prices. We also know that nothing fundamentally has changed. The setup is still there. We are still driving to Vegas and we will eventually get there. Yes, we may have to stop for gas or a bathroom break. We may hit some traffic that slows us down. But are we going to Vegas? Yes, we're going to Vegas come hell or high water. Just don't flinch. What this means for us is that we need to start looking at levels where we can start to sprinkle in some purchases as price recedes while being ready to pounce the moment we see price strength or the market's technicals change from bearish in the short term to bullish in the short term as well as the long term. When gold hits around 2250, I might pick up a quarter ounce and then maybe a half ounce at 2200. If silver hits somewhere around 2820, I might grab a tube or two. If it hits 27, I might grab 100 ounces or so. If it hits 26, well, I might be selling blood, plasma, and any other items I can sell to get as much silver as I can. That's my plan. What do I keep saying to you? You have to develop your own plan and work your plan. In the comments section, how low do you think gold and silver prices will go during this season of weakness? Do you have some purchase price targets? Or simply put an A+ in the comments to let everyone know that you always stack smarter and never stop learning.